All right, time to deep dive into the world of bonds. And from what we've got here, looks like you want to go beyond just Bond Basics 101, huh? Even some crypto stuff mixed in. This is going to be good.
Yeah, it should be interesting. And you've definitely picked some sources that are pretty beginner friendly, so that's a great place to start.
Awesome. So by the end of this, you'll be able to explain bonds to anyone and get why they matter, even if you're not out there trading them every day.
Sounds good to me.
Plus, we'll try to dig up at least one fact that'll make you the star of your next dinner party.
Deal.
Deal. Okay, so first things first. What exactly is a bond? Imagine lending money to a friend,
Right.
but this friend is like a huge e-company or even the government, and they promise to pay you back with interest. That's basically a bond.
Perfect way to put it. It really highlights that lender-borrower relationship, like an IOU from a company or the government.
Exactly. And like with any IOU, there's some key terms. Face value, that's what you get back when the bond matures. Then there's the coupon rate. That's like the interest rate on the loan.
Okay.
And then the maturity date, that's when you get your original loan back.
Yeah.
Simple enough.
So far, so good.
But now here's where it gets interesting. Bonds are different from stocks. With stocks, you're buying ownership in a company. But with bonds, you're the lender.
It's a great point, and I think it's something that confuses a lot of people. With a bond, you're not owning a piece of, say, Apple. You're lending them money for, I don't know, maybe a new data center or something.
Uh-huh. So instead of being a part owner, you're more like financing their operation.
Precisely.
Right.
And did you know that historically, bonds have played a huge role in funding, like, major infrastructure projects, even wars? For instance, during World War II, they issued war bonds to finance the war effort.
Wow. Talk about a dinner party fact. So bonds are essentially loans, but our sources mention different types: government, municipal, corporate, and even savings bonds. What's the deal with all those?
Right, so not all bonds are created equal. They carry different levels of risk based on who issued them. Government bonds, particularly those issued by, let's say, a financially stable country, are generally considered the safest.
Makes sense.
Municipal bonds, those depend on the financial health of the city or state that issued them.
Ah,
And then corporate bonds, those carry more risk because they're, tied to the company's performance.
it's like choosing between lending money to that reliable friend with a stable job versus someone who's a little more unpredictable.
Uh-huh. Great analogy. Now, after these bonds are issued, they don't just sit idle. They're actively traded in something we call bond markets. That's where things get even more exciting.
Bond markets. Sounds a little intimidating.
Think of it like a big marketplace. This is where bonds are bought and sold after they're initially issued. There's the primary market, where you buy bonds directly from whoever issued them.
Okay.
And then the secondary market, where investors trade bonds among themselves, similar to how stocks are traded.
Ah, so it's like buying a brand new car from a dealership versus buying a used car from, someone else.
You got it. And the secondary market is important because it provides what we call liquidity, meaning you're not stuck holding onto a bond until it matures. You have the flexibility to sell it if you need to, though its price might have changed.
Gotcha. So bonds are kind of like any other asset. Their prices can fluctuate, go up and down.
Right.
What causes these price changes?
This is where interest rates enter the picture. And get ready, because they have a very, let's say, interesting relationship with bond prices. It's an inverse relationship. So when interest rates rise, existing bonds, they become less attractive because newer bonds are offering higher yields. Here, let me explain.
You do.
Let's say you bought a bond last year and it had like a 5% interest rate. Now imagine interest rates in the market, they've jumped to 6%. Your bond, still paying 5%, suddenly doesn't look so hot compared to those new bonds offering 6%, right?
Yeah, that makes sense. Why would I settle for less if I can get a higher return elsewhere?
Exactly. So to compensate and make those older bonds more appealing to buyers, the price of your existing bond has to drop. This ensures that anyone buying your bond today, they're effectively getting a 6% return as well, matching that current market interest rate.
Okay. So as interest rates climb, existing bonds become less attractive, causing their prices to fall, like a balancing act to keep things competitive.
Exactly. And this dynamic, this dance between bond prices and interest rates, is why bond yields, the return you get on a bond, are super important. Everyone, investors and economists alike, keeps a close eye on them.
So it's not just about, making money from trading bonds, but these yields, they could be a sign of bigger economic trends.
Absolutely. Bond yields can actually give us a clue about where interest rates and even inflation might be headed. In fact, some economists believe that bond yields can sometimes foreshadow recessions.
Oh, really? Bond yields, like a crystal ball for the economy. Tell me more.
Well, it's tied to something called the yield curve, which
Mm.
we'll definitely dive into that later. It's basically a graph comparing yields of bonds that have different maturity dates.
Oh, interesting. So it's not just about the individual yield, but how those yields compare across different time frames.
Exactly. The shape of this yield curve, it can tell us a lot about what folks are expecting from the economy in the future, and maybe even some potential risks.
Yeah.
But before we get ahead of ourselves, let's switch gears for a sec. Why are bonds, especially government bonds, often seen as a safe haven, particularly when the economy gets a little rocky?
Yeah, safe haven. So why are bonds, especially those government bonds, considered like a safe bet when the economy gets all, I don't know, turbulent?
Well, you see, when things get uncertain in the financial markets, investors, they often look for kind of like stable ground to protect their investments, right?
Uh-huh.
And that's where bonds, particularly those issued by governments, they really shine. They offer sense of security, predictability, especially during times of like volatility.
I see. So it's like when you're on a crazy roller coaster ride and all you want is to get off and chill on something a little more gentle.
Exactly. And there are a few reasons why government bonds specifically are considered so safe. First, governments, well, they have the power to tax and even print money.
Right.
So that generally makes them more reliable borrowers than, say, companies. They're less likely to default on their debts.
Makes sense. Like it's like lending money to a friend who has a steady job and a history of paying you back.
Yeah.
You feel pretty confident you'll get your money back plus interest.
Exactly. And this perception of safety, it's crucial. When investors get nervous, maybe about the stock market or, just the economy in general,
Mhm.
they tend to flock to government bonds, like to protect their money.
Gotcha.
And this increased demand, well, it naturally drives bond prices up and yields down. Just basic supply and demand in action.
So it's like
Yeah.
a flight to quality. When things get shaky, investors seek out the reassurance of those government bonds.
Yeah.
But even with that safe haven thing going on, doesn't market sentiment still play a role? Like, can bond prices still fluctuate?
Oh, absolutely. Even government bonds, their prices can move up and down due to all sorts of things, like investor sentiment, inflation, maybe even some global event. Just like any other investment, they're not totally immune to those market forces.
So it's not like you buy a government bond and it's just like guaranteed to stay at the same price forever.
Right.
There's still some level of risk then.
Correct. No investment is entirely risk-free. Even with government bonds, you could face risks like inflation that erodes, the purchasing power of your returns, or interest rate changes, which can impact a bond's value.
Yeah.
But you're right. Compared to those often dramatic swings of the stock market, or how unpredictable crypto can be, bonds do offer a certain level of stability.
Makes sense. So safe haven,
Mm.
but still subject to some market forces.
Got it. Now, let's talk about diversification. How do bonds fit into a well-rounded investment portfolio?
Well, diversification, that's a fundamental principle in investing. It's like they say, don't put all your eggs in one basket. Including bonds in your portfolio, along with stocks and other assets, can help to balance out some of that volatility and potentially reduce your overall risk.
Right, right. It's like having a balanced meal. You wouldn't just eat cake all day, right? You need your veggies for a healthy diet. Bonds are like the veggies of your investment portfolio, providing that stability.
I love that. And you're right, stocks can offer the potential for high growth, but they also come with those higher risks. Bonds, on the other hand, tend to give you more of a steady income stream and help preserve your capital during those market downturns. It's all about finding that right mix of assets that, aligns with your risk tolerance and your long-term investment goals.
So it's about finding that balance, right, between chasing growth but also mitigating risk.
Right. Now, with all this talk about safety and stability, can bonds actually generate, significant returns? Or are they mostly about just preserving wealth?
That's a good question. So bond returns, they can really vary depending on a bunch of factors. Things like the type of bond, the issuer's creditworthiness, the interest rates at the time, even the maturity date.
Right.
There's no one-size-fits-all answer when it comes to returns. It's about understanding those specific characteristics and also considering the broader economic context.
I see. It's about making informed decisions then, not just, blindly chasing the highest number. But speaking of informed decisions, have you ever heard about bonds with super long maturities, like 100 years?
Yeah.
That sounds like a lifetime commitment.
Right. So there are bonds out there with incredibly long maturities, some stretching out as far as a century. They're not as common as those with shorter maturities, but they do exist and they cater to a specific kind of investor.
Wow, a 100-year bond. That's wild. Who would invest in something like that? It's like planting a tree that your great-grandchildren will get to enjoy the shade of.
And you'd be surprised. It might seem counterintuitive, but there are, for instance, institutional investors like pension funds or insurance companies. They have very long time horizons. Their strategies span decades.
Okay.
So they're willing to lock in a fixed rate of return for an extended period, even if it means waiting a century to get that principal back.
Huh?
These ultra long-term bonds, they offer a way to, secure that predictable income stream far into the future.
That's really interesting. It shows how bonds can be, I don't know, almost transgenerational. But
Yeah.
beyond those extreme cases, bonds play a huge role in the overall global financial system, don't they?
Absolutely. They influence government borrowing, they influence interest rates, even the way capital flows between countries.
Yep.
Even if you never personally buy a bond, just understanding how they work, their impact on the broader economy, well, it just makes you a more informed citizen. It's about connecting those dots and seeing how these financial tools really shape our world in so many ways.
Well said. Okay, so we've looked at that safe haven aspect of bonds,
Yeah.
their role in diversification, even those crazy century bonds. Now, let's circle back to that yield curve thing and its, potential as a predictor of economic downturns. Ready to unravel that mystery.
Okay, so we've made it. We've gone through like bond basics 101, different types, those crazy bond markets, even the whole safe haven thing. Now it's time for that mysterious yield curve. I got to admit, it does sound a bit sci-fi,
Yeah.
but you're saying it can actually give us clues about,
Yeah.
the future of the economy.
Right. It may sound a bit complex, but the yield curve, it's basically a visual. It shows us the interest rates on bonds with different maturities, all issued by usually the government. It's like a snapshot. It shows us how investors are feeling about the economy, over different time frames. So if I was going to lend money to the government for, say, 30 years, I'd expect to get a higher return than if I lent it for just a year.
Yeah.
Because, well, I'm taking on more risk. My money's tied up for way longer.
Exactly. That's the logic behind a normal yield curve, the upward sloping one. Longer term bonds, those typically have higher yields because investors want more compensation, right, for taking on that added risk,
Yeah.
lending their money out for a longer time.
Right, right. But you mentioned things get interesting, maybe even worrisome, when the curve inverts.
Yeah.
What exactly does that mean?
Yes, an inverted yield curve. That's when short-term interest rates are actually higher than long-term rates. It's like everything gets flipped.
Hmm.
And historically, this inversion, well, it's often been a sign that a recession might be on the horizon.
Hold on. Why would short-term rates ever be higher than long-term rates? Wouldn't investors always want that bigger return for, committing for longer?
Under normal circumstances, you'd be totally right. But an inverted yield curve, it suggests that investors are feeling a little uneasy, like about the long-term economic outlook. Maybe they're anticipating a slowdown, even a recession, which could lead to, well, the Fed lowering interest rates in the future.
Ah, I see. So they're thinking if rates are going to be lower later, I'd rather lock in a higher rate now, even if it's for a shorter time.
Yeah.
It's like trying to grab the best deal while they can.
Exactly. So this is surge in demand for those higher yielding short-term bonds. It pushes their rates up. At the same time, concerns about the long term, that weakens demand for long-term bonds. Their yields drop. And there you have it, an inverted yield curve.
Okay. Starting to get it now. It's like a signal that investors,
Yeah.
they're not so confident in the long term, huh?
Yeah.
But how reliable is this yield curve, really? Like, is it a foolproof recession predictor?
Well, an inverted yield curve has historically been a pretty good predictor of recessions.
Yeah.
But it's important to remember it's not a perfect crystal ball. There are a ton of factors that influence those big economic cycles. And the yield curve, well, it's just one piece of that puzzle.
So not a guarantee, but more like a
Yeah.
red flag, something to pay attention to.
Exactly. Other indicators like inflation, unemployment, how much people are spending, government policies, all those matter too. They help us paint that full picture of the economy.
So don't go making any big predictions based just on the yield curve then.
Haha.
But even with those caveats, it's still a pretty neat concept, right? It's a peek into how the market is, I don't know, feeling about the future.
Absolutely. The yield curve, it reflects the collective wisdom or maybe the collective anxiety of so many investors all making their own decisions, with their own decisions, with their own views and their own risk tolerance.
Like giant economic mood ring, reflecting the markets.
Love that. And on that note, I think we've successfully navigated the, let's say, complex world of bonds. We've explored what they are, their different personalities, the dynamics of the market, that whole safe haven idea, and even the predictive powers of the
Right.
yield curve.
Yeah, we covered a lot of ground, and hopefully you, our listener, feel a little more confident in understanding these things. You don't have to be a Wall Street whiz to get it right.
Exactly. And as we wrap up, I want to leave you with a thought. We talked about bonds being a safe haven, how demand for them goes up when things are uncertain.
Hmm.
So, what does the current demand for bonds tell us about how investors are feeling about the future? Something to think about as you go. Continue your own financial journey.
Ooh, good question. It's like our final exam question for Bond Deep Dive 101. But
Huh?
hey, if anyone tries to quiz you about bonds at your next dinner party, you'll be more than ready.
Happy bond exploring.
Thanks for joining us on the Deep Dive. We'll catch you next time.